Please welcome Chairman and CEO of MSCI, Henry A. Fernandez, Group Chief Executive of HSBC, Noel Quinn, Chair of Prudential PLC and Co-Chair of World Bank Private Sector Investment Lab, Shriti Vadera, for a conversation with UN Secretary General's Special Envoy on Climate Ambition and Solutions, Co-Chair of the Glasgow Financial Alliance for Net Zero, and Chair of Bloomberg, Mark Carney.
Great. Fantastic. Okay. Let me just say at the outset, I want to salute Mike. Thank you, Mike, for convening us here. Thank you for your leadership over the years, translation of ideas into action. This is what the theme is going to be here. I also want to just underscore, at least from my perspective, how important the announcement that Secretary Yellen just made and the content around that, these principles on transition financing and investment. And that's what we're here to talk about in the next 18 minutes, is how do you move from commitments, lots of commitments. We were all in Glasgow making commitments. You've made commitments before, but how do we move from those commitments to action? And we have three institutions, three firms that have been doing exactly that, and I'm going to ask some general questions around transition finance, but get into the details pretty quickly. And I want to start, if I may, with you, Noel, because you have co-led the hard yards, if you will, the work to develop the first phases of transition plans for financial institutions, not just banks, but financial institutions as a whole. You run one of the most complicated and global banks in the world. Why is it important to have this approach?
I think it's important for any company, but particularly financial services companies, to decompose what's meant by net zero by 2050. They're easy words to say, but all of our stakeholders want to understand how we're going to enact that, how are we going to deliver it, so that it's more than just a marketing promise. Now, my view of the best way to do that is to work with your clients on their journey, because the aggregate of their carbon footprint is the bank's carbon footprint. My Scope 3 emissions are the emissions of our clients. The best thing I can do is to set out very clearly, and any financial services companies to set out very clearly, how we are going to work with our customers on the transition plans that they are going to have to do in their sector of the economy. And we've also got to be honest, when we describe that journey that we're going to go on to deliver net zero, we have to be honest on what we know and what we do not know. There are some technologies we know will work, but they're not yet at scale, and the economics of those technologies are challenged. So describe those challenges and the opportunities. There are some technologies that are very nascent, they're very new, and we're not quite sure whether they will work or not. So being honest in your communication is important. Now, why is the transition plan document important? It mobilizes. It mobilizes customers. It mobilizes stakeholders. It buys them into that vision and that plan. And more importantly for me, it mobilizes over 200,000 people that work in the organization. It gives them a sense of purpose beyond just the strap line. And it educates them as well on the journey we as an institution want to go on. So it's a massive mobilization document. And I would advocate that the transition plan will be as important as the annual report and accounts going forward. That will be our vision of the next 20, 30 years. Fantastic.
So let me pick up on that last bit, if I may, Shriti. It's all about, in that regard, mobilization and leadership. And the Pru has been a leader. You were one of the first insurance companies to have a transition plan. I'm going to ask you what you're learning from that. What are some of the challenges? What are some of the issues that you've seen?
Thanks, Mark. Yes, we are very pleased with the transition plan. We've been commended for it. We engage with our portfolio companies exactly as Janet Yellen was asking. Based on those transition plans, we have it in our governance structure, we have it in our processes, we even have it in our remuneration for our senior management. So that's fantastic, and that's the good news. The challenges that we face, we are exclusively in Asia and Africa, and some of our markets are the largest emerging market emitters in the world. And the challenge we face is that we're meant to invest based on taxonomies and standards that have been designed without the voice of emerging markets being felt very strongly. And we're meant to be investing and financing their plans, their pathways for transition, their decarbonization plans, and their taxonomies don't exist in the country. We've now got the ASEAN taxonomy in sustainable finance. That's a great start. But otherwise we can't have a Western size fits all. That's not what it's meant to be. And secondly, the global capital markets works off standards and taxonomies that actually don't incentivize us to finance transition in emerging markets. Actually, they kind of pressure you to divest from fossil fuels, but they don't incentivize you to invest in transition finance. So if you take something simple like one of the most important targets is weighted average carbon intensity. If the Prudential did what we really want to do at the scale, it's not that we don't do it, at the scale and the size that is needed and that we would like to do it, our WACC, so to speak, would actually increase, not decrease. It would be very volatile, and I don't think our shareholders and our stakeholders really quite understand that. And the third thing is it's about data on emissions for emerging markets and companies in emerging markets. Otherwise, we don't know if we're pricing risk. We don't know if we're actually financing transition without this data. So I'm not wanting to sound discouraging about this, but if we want to be real at a scale that is going to make the difference, as opposed to all of us doing the things that we really can do at the margins, then we have to do something about the taxonomy, which I know, Mark, you're going to do.
We are going to do, because the next phase, this is a perfect setup.
This is my job.
Hot off the press, which is the defining transition finance and considerations for decarbonization methodologies. This is a consultation of GFANs between now and COP28. And because of Shriti's pushing Noel's leadership, Henry's leadership, and other leadership, what it does is it goes down to a more granular level on transition finance and going to where the emissions are, going to those companies that aren't yet aligned and are aligning, and importantly, would supplement a WACC, weighted average carbon per invested, with a decarbonization methodology. In other words, what are you doing with your investment, your lending? How much carbon is your client, Noel's, going back to Noel's client, going to take out of the atmosphere? No. So getting that there. But of course, we have to get it there. You've got 200,000 employees. You've got tens of thousands of clients. Same with you. We have 650 institutions and GFANs. We got a lot of data. Henry, we got a lot of data. I want to bring you in, how you look at data, how we're organizing it, and where we're headed.
So needless to say, the $100 trillion economy relies on measurements. If we say, what's the unemployment rate in this country, that country, what's the economic growth, how much trade between this and all of that, you need data and you need measurements and you need standards. So the climate transition is going to be an overlay on all of that. Yeah. So what doesn't get measured doesn't get done. We know that. So what we're focusing in those two components. The first component is, how do we go around measuring carbon emissions, future carbon emissions, valuation of assets, financial assets, risk of those assets, etc. So a lot of our work is in doing all of that. Now, for that, you need data and you need models. So we are, we're extremely focused on that. And at the moment, to give you a report of where we are, we have climate emission estimates on about 4 million financial instruments, which compose of about 1.1 million assets, meaning manufacturing plants, office buildings, mines, etc., storage facilities, etc. And when you distill it down to, it's about 68,000 companies and issuers, and about 70,000 funds, ETF funds, mutual funds, and private equity funds, private debt funds, etc. So we are focusing on the collection of the data, but that's a small part. You got to then model the data. to be able to understand what are the current emissions and the future emissions. So, for example, if you take all the listed companies in the world today, they emit somewhere about 12.5 billion metric tons. 20 years from now, our estimate is going to be 17.5 billion. We're not going in the right direction, 17.5 billion. So that's the first part. So our ambition is to be able to flood the world with so much data and measurements that they don't have to worry about the data and the measurements. That what they will worry about are the action plans associated with dealing with the transition. And then the problem then becomes not about collecting data, not about a measurement, but it's about measuring the action plans, measuring the progress people are making. So we are putting all the weight of the company, of MSCI, all of our people, it cuts across every part of what we do in achieving that goal in a few years' time. So this is not like decades away. These are only years away from being able to have all the data. Because again, the goal is to have a company, to have a pension plan, to have a sovereign wealth plan, to have an asset manager, and say, I don't need to worry about the data. I need to worry about the action plans about decarbonizing my portfolio or decarbonizing my company.
Yeah. Let me ask you one other question on the data, and we're at Climate Week. We have a broad range of stakeholders, some of them physically here, but they're representing people around the world of all levels. Where do they go to get the data? Where do they go to get the data that is that comparable, consistent data? And I know you're helping to lead this, which is a slightly leading question, helping to lead this through initiative, through GFANZ and others, to bring the data in an open source, open access way.
Yeah, so there will be two sources of data, right? There will be a lot of basic, fundamental, important data that will be in a public domain. Yeah. And we are strong and proud supporters of the Climate Data Steering Committee and the creation of the Net Zero Data Public Utility. Yeah. Because we're collecting data not because we have to, it's because nobody else is, right? And we're not waiting for regulators for issuing disclosure rules and all of that. We're not waiting for anybody because then the problem gets worse. So there will be that source of data, and there will be also deeper, wider, more model data as to what is the risk of the company, what's the risk of the asset, what is the future emissions and all of that, like as you know, implied temperature rise metrics and things like that, which is obviously very important. So what we're trying to do is to say, is there a basic foundational underlying data that everyone can use? And then instead of people competing on that, they should be competing on the models they build on top of that data to create evaluation models, risk models, climate action processes and the like.
Yeah, no, it's hugely important. It sounds like hardcore plumbing, and I guess in many respects it is, but the Net Zero Data Public Utility, all the major international institutions, including the European Commission with the President just here, supporters of this, heads IMF, OECD, etc., and then all the major data providers, MSCI, Refinitiv, Morningstar, S&P, Moody's, Bloomberg, all coming together to ensure that every stakeholder, every person in the world has access, free open source access, to compare banks around the world, financial institutions, regions, etc. Okay, around the world. I'm going to go to Shriti and Noel now, because you both rightly went into the issues in the emerging world and getting access to finance. And I don't want to overstate the progress in developed economies, but we're getting momentum, we're getting data, we're getting traction. We've got at least $1 trillion a year hole here outside of China in additional finance. So I'm going to go to you, Noel, first, and then Shriti, I'm going to give you the last word, rightly, given your leadership role here, to bring it together. So Noel, how are we attacking this problem? Where are we? What are the real priorities to get capital to the emerging developing world for climate?
Well, listen, certainly I can talk for Asia very deeply, but the most important thing I say, I'm very encouraged when I talk to clients and customers in Asia. Take India, for example, some of the largest corporates in India. The amount of money they are investing in building new infrastructure, using their own private sector capacity, requiring not a huge amount from the governments to make that investment become a reality, very often just planning consent. I'm encouraged that there's a huge amount of action already taking place on changing to green energy, on electrification. So there's a lot happening. However, there are some projects that require private and public sector to work together. The early retirement of coal cannot be achieved by the private sector alone. It requires public policy. It requires public financial support in certain countries. So those are challenging parts of the transition to a green energy. And I think we have to find a way to scale that fast. And I worry at the moment that too many of those conversations are happening project by project. There isn't an architecture. There isn't an agreed architecture for how the public and the private sector will work together on some of these more difficult problems. Yeah. There isn't a contract template that if you want to retire coal early, this is the way to put public sector finance together with private sector finance, together with public policy, take it off the shelf and make that work and get everybody pointing at that. The only way to get scale and rapid deployment on some of these projects is have standardization of methodology. And at the moment, it's all going through case by case, project by project, reinvent the wheel every time. And that, I don't think, will get us there fast enough.
Absolutely right. So, in search of that architecture, the ability to build that standardization, Shriti, you've taken on this role, co-chairing the lab.
With you.
Well, I'm there for show, you're there for substance. The Private Sector Investment Lab for the World Bank, for new president of the World Bank. And Noel, you're donating some time to this to get it. So it's a little unfair, but early impressions, or at least priorities as you see it, between incentives, between capital, between structures, to build out that architecture that can really fill this gap.
So Noel is completely right that in the absence of a carbon price, it's very hard for us to spontaneously, as a private sector, create the levels of finance that we're talking about. After all, we're financing quite often, global public goods and externality. Yeah. So we need to have the partnership with multilateral development banks as mobilizers in chief of private finance. But currently, they only mobilize about, say, 1.2 times, roughly, or even less, but in some cases, of the amount of money that they put into emerging markets. And we need to have multiples of that. And so Noel is completely right. The way to do that is to have models and financing structures that are speedy, with no disrespect to my dear friends at the various multilateral banks. I mean, you cannot be there for 3 years structuring something. It is just, we don't have the patience for it in the private sector. So we need to have something that is speedy, at scale, replicable, not bespoke, standardizable, creates liquidity in the market. And so what we're working on, what we've been thinking through, and we're going to have our first meeting this week, is what are the sorts of things that you just put out there. They're simplified in its scale and they're speedy, so it could be around guarantees. We had a discussion that you chaired this afternoon, Mark, on foreign exchange, which is a big deterrent for foreign investors. We could talk about securitizations, and we could talk about creating liquidity. So those are the sorts of things we're talking about. The one thing that I said to Mark is we're not going to write a report.
Definitely not.
We are not going to write a report.
We don't have time. We do not have time to write.
It's action, not
exactly.
reports.
We don't have time to write a report. Sadly, we don't have any more time to continue this discussion because we're going on to ACT and Speedy. And so thank you all for attending, and thank you for everything you're doing. Thank you.